The following program is sponsored by MaxOut Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, MaxOut Savings Advisors, or its sponsors. MaxOut Savings Advisors and members of the MaxOut Savings team may or may not hold securities mentioned during the show. Plan for your prosperity, prepare for your retirement, safeguard your savings, and nurture your investments. This is the MaxOut Savings Show with Ted Geoca, a presentation of MaxOut Savings Advisors. Now, here's your host from MaxOut Savings Advisors, Ted Geoca.
Good morning and welcome to the MaxOut Savings Show. I'm Ted Geoca and we're talking savings, investments, in your retirement here on the show. Our show is all about building up wealth, understanding the world today, and dealing with the ever-changing times. A world where things are constantly on the move, constantly changing. We have AI, we have new systems coming out. How do you deal with that? And how do you direct and manage retirement to 30 years of retirement? If you retired at age 65, how do you get up to basically 95 successfully? And I think it takes some planning. I think it takes the management of the funds and watching and conservative management. And it's because we've had good times now that will change. And you want to manage through that. So we're here to help you do that. Our motto and philosophy is to save aggressively and invest conservatively. That's the key to building up wealth over the long term. Save aggressively, invest conservatively. We always try to start that talking at the beginning of the show. You really want to start out. This week we have the Trump account started, which is you get $1,000 if your baby's born, and you put it away and it grows over time. And you can build up for savings for college or a home, but it's the same with the retirement. You start out, put away 10% plus the company match gets you up to 13-14%, and you put it away. Particularly when you're younger, that's when you want to put away a bunch of money initially, because eventually you're going to have to buy a house, you're going to get married, have kids. And things are going to come up over time. Maybe you switch jobs, you lose a job or something, you need funds. And so if you put away that 10% plus the company match, it usually gets you where you need to be for retirement. And then you conservatively invest it. Hence, save aggressively, invest conservatively. We say the minimum is 10%. It should be more than that. And to get you where you want to be, and then you can spend the rest. But it's a key. The United States, we started the show because the United States has one of the lowest savings rates in the world. It's improved, but some of the Asian countries have a savings rate twice what we have. And so we've got to keep up with it, and you got to protect yourself. Look, in a world, let's be realistic, in a world where there's $26 trillion worth of debt in the United States of America, does anybody really think that they're going to be for you there when you retire? I think you want to depend on Social Security, but it's going to get tougher and tougher over time to take advantage of it when you have this reckless government spending. One of the shocking things about even with the Trump administration is he's done a remarkable job, but how very difficult it is to cut spending. Congress won't work with them. The Republican Senate just wants to spend money infinitely. They're almost worthless. People tell me, we could lose the Senate. I'm like, who cares? You've got, John Cornyn, you've got McConnell, you got the rest of these clowns up there that were unable to get they can't even pass a simple law saying you need to have a voter ID. It's the Congress in modern day, not the Congress, but the modern day Senate, remarkably similar to the Roman Senate in Julius Caesar's time. It led to the downfall of Rome. I mean, you got a bunch of old guys that don't know what they're doing, and they're mad, and they're the adults in the room, and they're unable to do anything. So you got to depend on yourself for your retirement, for your savings, building up wealth. Now we got quite a bit to talk about on the show here today. We've got the markets are near all-time highs, but it really hasn't gone anywhere for a while. So what's going on? Oil prices have come down. If you look at West Texas crude, it's come down. It actually peaked it hit at 120 one day. And then, as I've said in the show numerous times, one of the most remarkable things I've ever seen happen in the financial markets is President Trump has managed to keep oil underneath $120, really, frankly, under $115 and $110 for all practical purposes, with the Straits of Hormuz shut down. Nobody would have taken that bet before this war happened. And so oil prices have now come down. They actually, if you look at the chart, they actually came back and closed the gap last week or the beginning of this week. The gap up when the war unexpectedly started. So oil prices are right back where they were. Now, refining margins are much higher. And so oil prices are still a little higher. But so where do we go from here? And I think this is something that we really want to take a look at here and figure out, what do we do? Where do we go from here? So what? A couple thoughts on that issue here. And let me just check something with the mic. Okay, yeah. Looking at the let me see if I can switch mics here. Okay, so one of the things to look at here is the what do we do with oil prices? And I think this is something we have to take a look at here. This week, President Trump has come out and Iran starts bombing the tankers going across the Gulf. So Trump retaliates over the weekend. And one thing you have to understand, in a modern world today, in countries with big stock markets, okay, wars are fought over the weekend. So you want to fight the war over the weekend, and then you want to get a deal done Monday morning. I mean, initially you have to fight it more than that, but eventually you get Monday morning, you get some type of settlement, and the markets calm down. And that's how he's been able to kind of manage oil prices. A couple things have happened that have changed. This is the question with Iran. It looks like they don't have a very stable country. It looks like there's really different power groups in charge, and one of them cuts a deal, and then it holds up for a week or two, and then another sector attacks. And the question is, are they pushing Iran to kind of break out into a civil war? So and that's a real possibility here. Because it really, you got one of the largest countries, larger country in the world, 90 million people, that there's really it's a very fractured functioning government. And so it makes it very difficult to deal with the situation. At the same time, we have the war in Ukraine, another war that just keeps on giving, that, should have never happened. And yet here we are. That is, what Zelensky's doing is he's using the drones to come in on top of Russia, and the Europeans are he's building a lot of drones. The Europeans are building a bunch of drones, and then they're bombing all of Russia's energy facilities. Well, now Russia has shut down the export of diesel fuel, jet fuel, and gasoline, and they're going to be possibly importing, which puts further demand on the whole sector overall. And so this is not a positive. And so this is further demand for oil and gas out there when inventories around the world are critically low. We've been at one of the two reasons we've kept oil prices this low has been, number one, Trump has been a absolute master of convincing everyone the war is going to end over the weekend, and it's just about to end, and no one's been afraid to go up against them and bet oil's going higher. And they probably leaned pretty heavily on some of the big commodity trading firms to get to, they better not see speculation in the market, and so they've been very good at this. And the other reason is that that we had huge inventories, which we've drawn down all the inventory. These inventories have to be rebuilt. So oil, if it's, they talk about there's demand destruction. There doesn't seem to be a lot of demand destruction. I mean, the president of Delta came out and said, well, yeah, oil prices are down, but we're not cutting fares. Which is just classic. I mean, the minute oil goes up, every company in the S&P 500 starts raising prices, and then when oil goes back down, they're nowhere to be seen on cutting prices, and their margins hit another record high every year. So what we're dealing with is they're all using oil to come up, but there's not been a huge amount of demand destruction. At the same time, they've got to refill these reservoirs. So I'm not convinced. I mean, I've been hearing $50 oil for the last year now. Oil's going to $50, and I'm not seeing it. There's a lot of demand for oil. There's demand for storage. And the oil companies are hearing the same $50 oil, and they're not going to go out and ramp up production and spend a huge amount of money if they can continue to cash flow the companies, which is doing a pretty good job. Oil companies have kind of learned a lesson. When oil goes to $100, they all increase production 5, 10, 20%, and then more oil's on the market, and then oil prices collapse down to 50, and then they put a bunch of debt on to fund this stuff, and they've kind of got religion. So we're not seeing oil prices go down as much. When it comes to inflation, it looks like we're going to see some deflation from oil, but if you look at the price of semiconductor chips, they're going up. Okay, we say, well, Ted, I'm not using AI, so I'm not affected. No, you're using your iPhone or your Samsung phone, or you're using a computer here, or you're using a video game, or all types of other devices that use storage chips in them that have doubled, tripled, quadrupled, or more in price. Apple just raised the prices of their Macs, their MacBook Airs, and all their other things, not the iPhones, because they're trying to convince the American government to let them use Chinese memory chips on those. And so we have inflation going up around the world. And as we said, oil prices are coming down, which means it's cheaper to pump. So ethylene, diesel fuel, gasoline, they're going to be dropping. But again, those Delta flights aren't dropping. The other places that have raised the prices up, they're not going to be cutting it. As we've said, oil is the biggest whipping boy. Companies raise the price of their products and people get upset and they turn and blame oil. So they take advantage of it. And so we still see inflation coming out there. We still see the war dragging on with Iran. I mean, hopefully we'll have a deal by 7:30, an hour before the markets open, so they stabilize and go back up again. I mean, that's kind of what everybody expects. But the problem still comes in is how do you deal with these dislocations around the world? And how do you deal with a very high stock market that's built on AI? And there's more and more problems with AI. There's more and more issues with, hey, this thing isn't really as profitable as everybody claims it is. Look, AI is fabulous for a couple things. You want to fight a war, you need AI. We've been doing that for a while, okay? Don't think that this AI that, ChatGPT and everything popped up out of nowhere, a year and a half ago. This has been used by the government for a long time. They finally released it to the public. And so it's great for fighting wars. It's great for writing code. It's great for testing code, for hackers and things like that. It's great for maybe doing some molecular research for drug. It's good for a lot of things, but also it's very expensive, and it's not good for a lot. The human brain is actually pretty darn good. I mean, that came up with AI, and what we're doing in the brain is remarkably efficient. So we're using basically AI that uses probably 100 times the energy of the human brain to figure out the same thing or more. And this is why energy costs, again, aren't going up. Natural gas is going to be going up. They're firing, when they come to AI, they talk about gigawatts of power. It's all about power. So there is opportunity out there. There's opportunity in energy and stuff. But again, understand Iran is very complex. It's not going away. President Trump would like a deal solved. Israel certainly doesn't want a deal. They want to continue the war. Iran, they're completely crazy. Trump gave them a deal that everyone was criticizing was too easy on them, and then they stupidly went to war again. So you're dealing with some very mentally unstable people. The nuclear weapon is the cornerstone of Iran's Islamic religion. I mean, it's like Christians have communion, and the Iranian Muslims, they have the nuclear bomb is like a sacrament to them, and so you're dealing with basic lunatics over there, and so it makes things very difficult. Now, I'll tell you what. Let's take a quick break. We're going to talk some more about this. We've got some very interesting things on drawdowns and IRAs, RMDs versus 4% rule. That's really pretty fascinating. We're discussing that. We're talking about some more things of really, what's happening and where are we going to go with this market? We've got some big things coming up. Markets that are all-time high. What are you doing here? We're going to be discussing that right after this quick break right here on the MaxOut Savings Show.
The MaxOut Savings Show with Ted Geoca will return shortly. To speak with Ted Geoca now, call 713-339-1070. Back in a moment with the MaxOut Savings Show.
I'm Ted Geoca, and I approve this message.
Inflation, instability of the market, bonds, precious metals, oil and gas, and lack of old-fashioned cash puts your retirement at risk. It takes a different type of portfolio to deal with these issues, and that's where Ted Geoca can come in, and he can help. Go to MaxOutSavings.com and schedule some time with Ted. That's MaxOutSavings.com. And listen to the MaxOut Savings Show every Saturday at 10 a.m. on AM 1070 and FM 103.3, The Answer.
I'm Sam Malone, president of 512 New Media. We're Houston's leading marketing and content creation firm for many reasons. Our assets are exceptional, from video production to web design, strategy, and the ability to say no. Saying no is integral in launching a successful, profitable campaign. For example, take a look at Memorial Day. It's a federal holiday set aside to honor and mourn those in our U.S. military who died while serving our country. I'll say it again, for those who died while serving our country. So how does having a sale work in unison with the reason for the day off? Look, we know people will be at the beach and barbecuing and having parties. We would probably say no to launching a Memorial Day sale. So is there another way to commemorate the day while marketing your brand? Absolutely. And from our experience, the same holds true with Easter Day sales and MLK Day sales and Christmas Day sales. That's why we're different. No cookie cutter, follow the crowd, template marketing. Let's talk. We're 512 New Media. 512 New Media. With better marketing comes better value, creating better results.
In the 1970s, the big song was the Bee Gees' Stayed Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Geoca of the MaxOut Savings Show. If you need help with your retirement, I'd like to help you out. Go to MaxOutSavings.com. That's MaxOutSavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement.
This is AM 1070, The Answer.
We return now to the MaxOut Savings Show. Here's Ted Geoca.
Welcome to the MaxOut Savings Show. I want to talk about one of our sponsors today, Advanced Longevity Center here in Houston. What they do is they are a non-insurance pay health company that will take a look at your health situation and kind of guide you of what issues you have. What they have is full body scans, MRIs, and to do so they can take a look at you and see, hey, how healthy am I? Do I have any problems? Now, as I said, insurance won't pay for this, but it's a reasonable price, and they will do a whole body scan. And they will sit there and take a look at your health situation. And at MaxOut Savings Advisors, we believe health is one of the primary things when it comes to retirement, almost as much so, possibly more so than money, really. And people plan for retirement but they just kind of go along with their health. If something pops up, they go see the doctor. This lets you be a little bit more proactive. It lets you come in and take a look at your situation, see, hey, oh, whoa, there's a developing problem here. I need to keep an eye on it, or I need to change my lifestyle. And I think this is very helpful, particularly if you have in your family, if you have health issues, with your parents or grandparents that you can see with different types of things. This lets you determine, do you have that issue? They can actually do DNA testing if need be. They can do tests to sit there and see. And they'll do the full body scan, which it's remarkable. It takes like 5 minutes. I couldn't believe it. And then they go through, and then it gives you like 600 scans of different scans of your body, and they go through and they can see different things. It's like looking at a video of your body, and they can really see where, hey, you have a potential problem here, or hey, you're having this. Take a look at this, and you can see it, and it really brings home the situation really remarkably much clearer than if the doctor sort of says, hey, we're seeing this, a little of this or whatever, you want to watch your eating. This kind of clarifies, and it particularly if some people are very nervous and worried that they might have something, this lets you go take a look at that, determine, hey, what is my health? What do I need to do? And they have DNA testing. They have a number of other things, but the full body scans are just absolutely fascinating. And so if you need some help with this, and we're going to be talking some more about this show, it's advanced longevity here in Houston, Texas. Their center's in Bel Air, and for the price is pretty reasonable. They'll do the whole body scan, and then they'll send it over to your doctor. They can take a look at the situation and then make recommendations. And oftentimes it's simply, hey, you're in good health. Take a look at here. We're seeing a little of this or a little of that. It picks up all types of stuff in there, actually, and which is just remarkable. I remember a friend of mine, he was in an auto accident, and he got one of these, and he was saying, oh, they found out that he had gallstones, and it was like, so he didn't know. So it's not a problem, but it lets you get ahead of problems, I believe. And so if you get a chance, take a look at them, Advanced Longevity here in Houston, Texas at their Bel Air Center, and mention that the MaxOut Savings program sent you there. And really this goes back to really our very strong belief that health is, you have to really work on eating, you have to work on exercise, taking care of yourself. I mean, I try to eat well. I mean, sometimes that fails pretty badly, but I really try to sit there and do it because this makes a huge difference on how long you're going to live, on the quality of your life, and so you want to pay, and it's the small things. It's walking a mile or a half a mile, 2 or 3 times a week. It's eating well. It's getting rid of some of the seed oils, having more things like olive oil, healthy things like that. Those all make a difference. Taking a look at the ingredients, but this is going to improve the quality of your life. I was talking to one friend of mine, and I said, I asked them where they're going or something. They came back from a European trip, and I said, well, we might do something here soon. And the response was, Ted, do it earlier while you still can, while you've got good health. And so you want to keep that health going. So if you're thinking about this, Advanced Longevity here in Houston, Texas, as for about the full body scan, and again, you have to pay for it, but it's not covered by insurance, but then you take it to your doctor. But this kind of lets you take charge of your health yourself. So what do we do? Looking at, one thing I want to cover is I get a lot of questions about the RMDs. Once you turn 73 and a half, you have to required to take a required minimum distribution. It used to be age 70 and a half, now it's 73. There's also, how much do I take out for retirement? I get questions, and people do these huge plans, and run them on computers and stuff. And it's pretty simple. William Benjamin did a study on this, and it came out to be about 4.2%, somewhere in there. You could take out each year and then kind of grow it with inflation out of the account. Now, and that'll last you through retirement. They did different studies on that. Now, some people say you can do more. Some people say you can do less. There's also the required minimum distribution, which the government strategy is, look, we want all your money out of your IRA by the time you die. That's kind of ideally what we like. We don't want people living to be 100 and their IRA grows to 10 or 20 million dollars and we don't get any tax money off of it. So this is their plan is if you're making enough money, you don't have to take that money out of your IRA. And we have clients that do that, a lot of our clients are big savers at MaxOut on the MaxOut Savings Show. But then they go, look, we got to take out your RMD now. So those numbers, it works out like this. Starting at age 73, you have to the number is about 3.77%. Now it goes up over time. So at age 80, it's about 4.9%, almost 5%. And at age 90, it's 8% a year has to come out of the plan. My mom has to deal with it. She's 94. At 95, it's 11.24%. It's a lot of money has to come out of these plans. So it goes up every year. Now, at age 65, there is a table for younger people. It's 2.95% is what you have to take out. So, and what people have noticed is, wait, this plan isn't that bad. The RMD actually does a reasonably good job. Now, the interesting thing, the RMD method takes less money out than the 4.2% interest. I mean, the 4.2% or 4% that's taken out. And there was a study done. Now, look, as long as the markets are going up like they are nowadays, this is not a problem, okay? The problem comes in when you get a flat market or a down market. We've had decades where the market has done nothing. Japan just hit a new high a year or so back. That's the first time since, I want to say, 1996 or something. Think about that. So if you're going to have a 30-year lifespan at retirement, that's a long time, and you don't want to run out of money. So they did the studies, and what they came up with, they looked at 1966, 65, where the market kind of peaked in 66, and then it went down and didn't really do anything, and then it had a big bull market starting in 83. So if you took $1 million in 1965, 66, $1 million, you were really rich. Rest assured. Okay, there were no $1 million, very few $1 million IRAs in 65. But for this, we use this. You got, the number was about 29 points. So you got $29,500 out. Now, if you did the 40% or so, they used 40.03. It worked out to be 40,300. Then it went up with inflation over time. Now, the issue came in is by the time you were hit age 90, you had, after 30 years, you had basically $2,900 left with the 4% plan. Because remember, the market in 66 went up, and then it had a big sell-off. So by 75, your RMD, which was the percentage at the time, so that was about 10. So that was about 75. So you were taking out about say maybe 4%. It went down to $17,000. So you went from 29 to 17,000, which was a real problem. But by 1995, you were getting $70,000 a year, and you were getting less in the 4%, and you had a residual by 1995 of $800,000 versus $2,900, and you effectively ran out of money with the 4%. So there's a couple different ways to do this. If you look at it, by the age 73, you're at 3.77%. So it's almost the same as the 4.2. But I think by adjusting the amount, I think the moral of the story to this is, if we get in a bear market, you've got to reduce your spending to some extent and cut back. Now, the 40% grows with inflation every year, but if you get a down market, the market goes down 10% or so, I would not raise my income that year. I mean, I would, at a minimum, if you can use the 4%, if the market starts slowing down, you want to freeze your increases because you don't know when it's going to come back and you don't want to pull too much out of it. And so that, I think the real moral to this story is if the market sells off, rather than keeping the income, raising your income, it's very important to pull it back some. And this is so important because, look, about 1970 to 1982, the market went nowhere. If you look at the market in 29 to about 40 to close to 50, the market went nowhere. It went down big and then came back up. So there's been numerous times when decades when the market didn't do anything. And so you've got to be very careful when using the 4% rule growing with inflation. The real danger is if you're retired and you're taking money out of your account to live off, you have to run somewhat scared to some extent. Look, the market's been up for 3 years in a row. It's a pretty good stock market, okay? But this is not the norm. If you look at P ratios, they're very high. Price to sales ratios very high. Price to cash flow very high. If you look at the market cap of the U.S. stock market, it's like 250% of GDP. That's very high. So you can't always start at that. So a couple of ways to look at this. What I would say is if you don't really need the money, I wouldn't use the 4% rule. I would go with the RMD rule until you were late in your later years, and then I would just try to keep it at like 4% when it gets too high. In your earlier years for retirement, I would look at the RMD side. In the later years, I would look at the 4% side, 4% rule. That's just, I think that's a better way to play it. And if you're taking money out of your plan, I would be very careful if you're on a set thing, if we get a big pullback in the stock market. Now, we try very, very hard at MaxOut Savings Advisors, knock on wood, to deal with bad markets, and I think we're actually exceptionally good at it to stabilize the portfolios. But it's something to think about. If you're just in your RMDs, remember, if you're just taking the money in RMDs, the RMD is going to adjust for you each year, and you kind of don't have a choice with it, but it will adjust it. So if things are bad, it'll pull back the next year. Now the danger is if the market sells off, then you really have a problem the next year with the RMD, because you could sit there and run into problems with you got to take, if you're in your later, let's say you're 80 years old, you have to take out 5%. Well, if the markets sell off 15%, that gets to be you got to take it out then. And so if the markets look like they're going to go down, you're better off, or it looks like something's going to happen, if there's a war coming up or something, take those RMDs earlier rather than later, because you might be if you've got high price stock, you can sell it earlier in the year. Whereas if it's the end of the year and the market sells off, then you're going to be stuck. Now, if the market's going up, you can take the RMD at the end of the year and your stocks went up, and you can then sell your stocks and they've appreciated and get more RMD back. It's kind of it's a little bit complicated, but the key thing to understand is the RMDs actually will work better in a flat market to a down market at protecting your wealth, and something to think about. And the fascinating thing is that's with much bigger amounts taken out later on. And so if you're worried about your future and stuff, if you have enough money, the RMDs are oftentimes a little bit better way to take money out of an IRA versus the 4% binge-in rule that's been kind of the standard. Now, some people are saying you can take out 4.5%, 5% now, but I think that's the result of very good stock markets that won't always be there. So anyway, so what? Let's take a quick break right here on the Max Out Savings Show, and we'll be right back to talk more about what's going on with the markets, what's going on with AI, where are we going from here. We'll be right back right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Geoca will return shortly. To speak with Ted Geoca now, call 713-339-1070. Back in a moment with the Max Out Savings Show.
I'm Ted Geoca, and I approve this message.
MaxOut Savings is looking at rising interest rates, the bond market, and our country's spending to project the impact on your retirement. They use that data to help you flex to current conditions with your future in mind. Call 713-627-0400 to learn more. That's 713-627-0400 or MaxOutSavings.com. Remember, you can hear the MaxOut Savings program right here Saturdays at 10 a.m. on AM 1070 and FM 103.3. The Answer.
Hi, I'm Sam Malone, the owner of Houston's cutting-edge media company called 512 New Media. At 512 New Media, we create amazing videos that companies use on their websites, telling their story in bold colors with exciting animation and graphics. At 512 New Media, we also shoot television commercials and instructional videos. And if you want to show off your business from the air, we're ready to go with our drone video aircraft. Let us help you create your media message. We're online at 512newmedia.com or call 281-822-8803. 512 New Media is Houston's only media creation and distribution company that's actually owned by someone who's currently on the air. And that gives us an incredible edge when creating content for consumers to use on their laptops, tablets, and smartphones. Standing by to create your message, we're 512 New Media, 512newmedia.com.
This is Ted Geoca, host of the Max Out Savings Show, one of Houston's most popular financial radio shows, celebrating over a decade on the air in Houston, Texas. With stocks at record high valuations and interest rates near record lows, you need to have your guard up. You need to have a plan to manage risk to your retirement. Do you? At MaxOut Savings Advisors, we have a risk-based value investing approach to your retirement. If you would like some help managing your retirement, go to MaxOutSavings.com to set up an appointment. That's MaxOutSavings.com.
If you can snap your fingers, you can find this radio station. So the next time you want to listen to us, your smartphone is now your smart radio. We're always on. This is AM 1070, The Answer.
We return now to the Max Out Savings Show. Here's Ted Geoca.
Welcome back to the Max Out Savings Show. We've got a couple calls that come in to 713-339-1070 here on the show. I think let's try to get Charles on. Charles, welcome to the Max Out Savings Show.
Good morning, Ted. You can hear me?
Oh, yeah. Morning.
Okay. All right. Ted, I had a question just to offer a quick comment on what you were saying. Anybody that's never looked at those longevity tables and all for the RMDs, usually by the time you hit, I think 90, you're pushing almost 6%. So, people need to kind of keep that in the back of their mind, because otherwise, if you're in your 90s or early 90s, I mean, if you've gone through most of your money, then it I don't know really what, for most people, what their plans are, but that's just something.
It's actually 88%. That's a good point. Where the RMDs really make that seem to do real well is earlier on. They tend to do pretty well. The key to the RMD is when the market sells off, it pulls your RMD, your required minimum distribution, back. It reduces it. Versus on the 4%, people keep taking the same amount out, and you have 2 or 3 bad years in the market, and you're taking out 3% of the all-time high. All of a sudden that gets to be a big number. Yeah.
Well, Ted, my purpose for calling is I don't know if you saw, I guess Elizabeth Warren and I don't know, there was some other Republican senator. They were coming up with a plan to address the Social Security shortfall, and I think what they were trying or proposing, what at least I heard, maybe you heard it, is that for Social Security wages, it's usually capped at a certain amount. I don't know if it's 180,000 or I don't know what the number is. But the point is what they're proposing is to extend the life of Social Security, just take away the cap, and now everybody pays that amount. So if if your income is, in the millions, you're going to pay that. You're going to pay that amount. And what they're saying is that should push Social Security funding all the way out. I don't know if they said another century or whatever, but basically it was going to be in a decade. So I was wondering what your thoughts were on that.
Yeah, I mean, look, they're going to have to do something, because that's the thing that scares people the most is Social Security, and they're going to have to do something. And that doesn't seem to be an unreasonable idea. Likely you're going to put a cap, maybe you could even cap it instead of that number. Maybe it's $500,000, something along those lines, or 300,000. I think you can see some stuff like that.
What they were saying was that if you just remove the cap, then in other words, whether you're Jeff Bezos or whoever, I mean, you're going to just pay, that amount going forward, and then they don't have to keep revisiting it. And I don't know. I mean, I guess because the other thing is either you cut benefits or you start playing around or having people work longer. And I mean, that some of that.
Well, I tell you this, the scary thing actually for a lot of our clients is they go, well, if you've got X dollars in your plan, your thing gets cut back. And that's why I'm not as concerned about raising the cap on the income, because instead what they could do is they could go, well, retirees that if they've got $1 million in their plan, they only get 80% of their thing. And that's the scary thing. So I actually support raising the cap more so, because the alternative is not good for a lot of middle and upper middle class saver retirees.
Right.
Because they're the ones that are going to get hurt by this whole thing.
Right. Okay. All right. Well, I'll let you go, but thanks anyway.
Good point, Charles. Thanks for the call. I think we've got Tom on the line. Do we have Tom?
Good morning, Ted.
Morning.
So listening to you talk about all the RMD stuff hit close to home for me, because that's where I'm at now. I've hit the RMD age, and I don't necessarily need the money to live on, but obviously I have no choice. I got to take it. And I've been researching, options and things, and the first thing that came that I've actually already started doing is QCD, is qualified charitable distribution, which is nice because you can contribute right to a charity, and it counts against your RMD, so it doesn't affect you tax-wise.
Yes.
But where my questions are, where I've gotten confused, that I'd like you to comment on, as I've looked into this, and apparently it's something new, maybe related to some of the last tax bills, is a qualified charitable gift annuity. And again, from what I can read, you're limited to only like a one-time $55,000, and that would count against your RMD, just like a QCD. But of course, it's going to create an income stream down the road. So that's going to hurt you on taxes too. And finally, the other thing I've found is something called a QLAC, a qualified lifetime annuity. And it looks like you can put $200,000 into that, but again, it creates an income stream down the road. So maybe avoiding taxes because these distributions don't become taxable, but they do meet the requirement of RMD. But then they turn around and create an income stream. The charitable gift annuity, of course, helps support the charity, which is a good thing. So what are your comments on all that?
I think I'm not as familiar with the last two. I think they're all good ideas, though. But the QCD, we do a lot of those. This is underutilized by most savers. And what you can do is, let's say the church is usually the one that clients go with us on, and let's say you're giving $2,000 or $5,000 or $10,000 a year to a charity, to a church. Well, you can just say, hey, call your advisor like me. Hey, Ted, could you send over a $5,000 check to Second Baptist in my name, and we'll send out the check. Charles Schwab will send out the check to them. We use Schwab to hold our assets. And then what happens is when you get your 1099-R, it doesn't show, it shows the income is 5,000 less, but you can't take the 5,000 off your taxes, but they never appeared, which reduces your adjusted gross income. And that is a real simple way. It's not real complicated at all. And the check goes directly to the charity, and you can do it to, your college or hospital or whatever, or, Red Cross, but, that is underutilized by most people, the QCD. If this really helps out, if it's like a build at the church or whatever, where it's a bigger amount of money, then it really makes a big difference.
Yeah, you're right, and it is simple, and that's one reason I was able to figure it out. And actually, your example is very good. I'm already using that to contribute directly to the church, from the IRA. It's those other two things is where I get confused, and I don't know if you have any comments about them, the charitable gift annuity and the QLAC, because again, those, are not taxable as far as your RMD distribution, but they create income streams, and I'm wondering if it becomes a wash, or is it sort of like robbing Peter to pay Paul, or
well,
you've
that
any
probably
thoughts
could
on
be.
those? Because I'm not sure what to do about them.
Those, I'm not real familiar with those, but those could be used. Let's say you give a bigger amount. I'm going to donate $50,000 over 10 years. You could possibly do that and not take out the total 50, because you would get a bigger amount through the annuitized income stream, and that could also help out. And then you take out, let's say it's $45,000, let's say it's $45,000 or $42,000 now, and you take that out, and it doesn't show up on your income taxes or your adjusted gross income, and then you get credit with the charity for $50,000. I believe that's the way that works.
Yeah, well, that's what I'm still trying to figure out, and I was kind of curious what your thoughts were on that. So, but yes, definitely, QCD is a good thing as far as a way to directly contribute. So, yeah, those other two I'm still trying to figure out. So,
yeah, Tom, this is a good call. These are really underutilized by people. If you're giving a reasonable amount of money to a charity, it's a really good way to go, because it takes it right off of that adjusted gross income, which is sometimes used to calculate your Social Security or Medicare and those types of things, and so it works very well.
Yeah, no, I mean, you're right, because it comes off the adjusted gross income. Of course, when you do that, you can't take a deduction, but who cares, because everybody's taking the standard deduction now anyway. So
yeah, that's right.
That's all good thoughts. Appreciate the input.
Okay, thanks, Tom. Good point. Yeah, and so this, again, the QCD is qualified charitable distribution. It's used to take money out of an IRA account instead of your RMD. Let's say if your RMD is $10,000 a year, you can take the $10,000. You can say, send me a check for $5,000, and send a check to, again, the Second Baptist as an example, and they'll send it out. Now, when you get your 1099, it'll show that there was $5,000 taken out, but you can't deduct the $5,000 out of the thing. But it reduces your adjusted gross income. Very, very simple. QCD, qualified charitable distribution. Talk to your advisor on it. As we talked about, for the RMDs, if you retire younger, it's actually maybe a little bit better way to take money out versus the 4% rule. You've got to calculate it out. But what it really shows us, if the market starts going down for a year or two, it's very important not to raise those distributions you're getting from your IRAs, but to make sure you have enough money, because your assets are pulled down and you're pulling out a bigger percentage. And that's something to watch. Because the 4% rule, you set it at 4%, then it grows 4% a year. And so it's kind of a set number. It's not 4% each year. I oftentimes tell people to take out just 4% a year, but there's different ways to do it. Now, a couple things. Markets here. What do we do? I mean, this week, Hynix came out, a big Korean chip manufacturer. They raised about $28-29 billion. This is after these are the SpaceX deal, two of the biggest IPOs ever. Again, a lot of money is being taken out of the market into new issues. We're seeing the big Mag 7 really aren't going anywhere. They're having to spend huge amounts of money. Hynex is spending, they're going to spend $29 billion, I guess part of it in the United States, building more factories. Huge amounts of CapEx going on. That's going to hurt earnings of these big companies, as we've talked about. The markets have the economy looks very good. We've got lots of factories coming back. We have AI centers coming back. We've got commodity prices good. Things are good. But we have the midterms coming up. Typically, if you over the last 20 years, the market's almost always had a decline in this, June, July, August time frame with the market. Now we've got a partial hedge on. We took some of it off here this week, but we're still real cautious in here because people are going to start looking at the midterms and go, is President Trump going to lose the Senate and the House? If that happens, there's going to be impeachments. Everybody's going to get impeached. I mean, every one of us will probably get impeached. There'll be so many impeachments. And it's just going to be very disruptive. And so the market's going to start running their calculus on this. And the other question is, what is the situation with the Iran war? I think we've probably seen the bottom in oil prices, at least for a while, because they have to rebuild the stockpiles. And what's going, again, we're dealing with a very unstable situation in Iran. And frankly, the Ukraine-Russia war is getting worse. And now they're attacking energy production facilities in Russia, which means there's less oil, there's less diesel fuel, there's less gasoline, and there's less jet fuel out there. So this is going to be a problem. And so these energy prices aren't going to go down. We have the memory shortages pushing up the price of AI, pushing up the price of computers, pushing up the price of calculators, pushing up the price of cell phones. So that's, again, more inflationary. So I think you want to continue to be very cautious in this market. You want to spread your risk out. You want to keep your bonds shorter term until we get an idea of what's going to happen. I like moving the bonds out about 2 years. You're locking in 4% or more good, solid returns for just 2 years and protecting yourself there. I think caution, you still want to be in the air. Now, a couple things. The MaxOut Savings Report, we have a free MaxOut Savings report that goes out once a month. If you just go to the website, maxoutsavings.com, request it. Every once in a while, we talk about savings, investment, retirement, RMDs. Every once in a while, we'll bottle lightning in that report, and we'll come up with stuff that said, hey, there's a real severe problem. We talked about COVID. We were way ahead of everybody else on COVID. We were way ahead of 2007. We said there was going to be a collapse in an investment bank on Wall Street. Nobody believed it. We bring a lot of very complex issues, make them very simple. It's a free report. We don't call you up. We don't send you anything. It's just the free report. Just go to the website, maxoutsavings.com. We talk about retirement and savings in the MaxOut Savings Report and request it. You can also request a meeting with me. I'll sit down with you here in Houston, Texas, and show you how we manage retirement funds using our value investing approach to the stock and bond market. So if you need some help, go to the website, maxoutsavings.com, get my phone number, email, drop us a line, and we can set up an appointment. But until then, remember our motto and philosophy, which is to save aggressively and invest conservatively. That, my friends, is the key to building up wealth over the long term. Save aggressively and invest conservatively. We'll see you next week right here on the MaxOut Savings Show.
This has been the MaxOut Savings Show with Ted Geoca, a presentation of MaxOut Savings Advisors. Join us next Saturday at 10 a.m. for the MaxOut Savings Show with Ted Geoca on AM 1070. The Answer.